On your marks, get set, invest. So when should you invest your money in the markets? Next month? Next year? No, dude, you gotta get in right now. The market's going to the moon. There are two main schools of thought on timing your investments. School number one, don't bother trying to time your investing. School number two, do bother trying to time your investing. Remember, there's no best way to invest, so don't worry, we're going to cover both approaches, and then you can choose. Like Frank Sinatra says, I did it my way. Markets go up and down over time. All markets tend to have these waves. The upward waves are called bull markets. The downward waves, bear markets. Not all shares follow along with the market's bull and bear trends, but most of them do. So, naturally, some bright sparks decided it would be a good idea to try to buy shares at the bottom of each wave and then sell at the top, and then wait until the market goes back down and then buy them again. Legendary fundamental investor Warren Buffett once said, "Be fearful when others are greedy. Be greedy when others are fearful." He's saying when investors reach the absolute depths of despair in a bear market and they're all selling their shares, then that's the best time to buy, because shares are at their cheapest and the despair will likely turn back into optimism. As the old saying goes, the darkest hour is just before dawn. There is a problem, of course, and the problem is in the real world it's rarely quite that simple. For example, you think it's the bottom, so you buy. But it turns out you're only halfway down. Investors sometimes call this strategy trying to catch a falling knife. Ow! Or even worse, you sell at what you think is the top, only to discover that the market has its biggest surge in history and you've missed most of it. So a lot of investment advisors say, don't even try to time the market. Just put your money in right now and let the miracle of compounding take care of the rest. Remember that from episode 2? The earlier you start investing, the sooner you start getting dividend payments from the companies you invest in, and when you reinvest those dividends, it helps your money grow or compound faster and faster. Oh look, it's our old friend Low Risk. Do you have a question for us? Good point, Low Risk. Good point indeed. Low Risk is asking whether it's such a good idea to put all your investment money into the market all at once. Because what if it turns out that you're putting it all in right at the top, just before a major crash? It could be years, maybe even decades before your investments return to the value that you bought them at, let alone make any kind of profit. So is it perhaps a better idea to drip feed your money into investments over a period of time? This idea is known as pound cost averaging. It means spreading out your investing over time, drip feeding your money into the market, so that hopefully the times you buy at high prices are averaged out by all the times that you bought at low prices. Now the main problem with this idea is you miss out on the benefits of compounding by keeping most of your money out of the market for a while, waiting for its turn to be drip fed in. So in short, there's just no consensus on this issue, because on the one hand, it's more risky to dump all your investing money into the market at the same time, but by pound cost averaging, you may well end up with lower returns overall after a number of years. So once again, it comes down largely to your attitude to risk. If you're very wary of taking risk, then pound cost averaging makes more sense. But if you're going for a higher return with higher risk, then investing it all straight away may be more justified. So can we do better than this almost random approach to timing? Some people believe we can. The traditional approach, derived from the fundamental investing techniques we looked at in our previous videos, is to identify when a share is cheap compared to other similar shares. So for example, say there are 4 supermarket companies. 3 of them have seen their share prices rising steadily as their profits and revenues rise. You may remember from episode 4 that people looking for cheap or value shares like to use various ratios, such as the price-earnings ratio, to help them gauge whether or not a share is undervalued by other investors. Now, because these 3 companies' share prices are rising and rising, they all end up with price-earnings ratios of 15. Meanwhile, here's CashSave Priceways, which is also growing its revenues and profits, but is not popular with investors at the moment, so its share price has been lagging behind the others, and its price-earnings ratio is only 7. A lower price-earnings ratio, all other things being equal, means a cheaper share price compared to the company's profits, and that suggests that the company may be undervalued. So many investors would probably leap at this opportunity. They'd start buying up the shares. And if enough of them started doing that, then the share price would eventually rise faster, pushed up by all the buying pressure, until it was in line with the other supermarkets. The investors who bought when the PE ratio was 7 can then sell for a nice healthy profit, a reward for their value spotting skills. Now, the reason these underpriced shares exist is because we humans aren't perfectly rational creatures. We're driven by emotions, which sometimes push prices up too high or too low. Even the greatest investors are still human and make a lot of the mistakes that newbies make. They've just disciplined themselves to make those mistakes less often. Sometimes individual companies also go in and out of fashion with investors for reasons completely unrelated to their profit and revenue growth. Perhaps cash-save Priceways was just considered a bit boring and uncool, so investors lost interest in it. But it was still busily making money, so its shares were a bargain waiting to be snapped up. The mispricing of shares gives canny investors many opportunities to profit. If shares were always priced perfectly rationally according to their fundamentals, then share charts would move sideways like this, and every so often there would be a piece of news about the company that changed the fundamental value, and then people would immediately buy the shares until the price reached the new true value of the company. If the price adjusted to a fair price suddenly like this, then most investors wouldn't have a chance to buy it before the price had fully adjusted to the new level. But instead, in real life, when a company enters a new, stronger phase of growth, it typically takes investors a while to get their head around the change in expectations for the company. They don't all cotton on straight away, so the shares are bought slowly as more and more investors start to get the picture. So what we tend to end up with are prices that trend slowly upwards over long periods of time, and that gives investors time to get in before the price rises. Now, the people who focus particularly on identifying these trends are known as momentum investors. They see a share price heading upwards steadily and they become interested. But how do we define heading upwards? Well, first we need to know what time frame we're talking about. I think we can all agree that this chart is heading upwards, right? But how about now? Am I still riding an upward trend or not? And how about now? The short-term trend is upward, the medium-term trend is downward, and the long-term trend is upward. Now, a long-term investor might look at this trend and think, yep, this is heading in the right direction for my long-term time frame. They might hesitate before buying this share for other reasons, though. They might feel the price has already risen in one direction for so long that it's bound to reverse soon. No upward trend lasts forever, particularly if the company is not growing its profits and revenues particularly fast. Some investors get around that fear by trying to do something called buy the dip. This phrase is repeated like a mantra by many investors. Because trends tend to rise in a staircase-like pattern, many investors think it makes more sense to buy shares during one of the periodic dips or corrections. The only problem with this strategy is that sometimes it turns out not to be a dip you're buying after all, but actually the beginning of a price collapse. And it can be hard to tell the difference until it actually happens. Investors use various chart tools to gauge whether an individual stock or the entire market is in a bull trend or a bear trend. There are gazillions of chart tools that have been invented, but unless you understand how they work, and indeed whether they work, then you need to consider whether they're really helping you or just confusing you. We're going to focus on support and resistance levels and moving averages, because these basic tools can be very beneficial. A moving average is simply a tool to smooth out some of the ups and downs in the price line, so that it's a bit easier to see the general trend with the naked eye. A simple moving average takes the price of the share over a number of recent days and plots the average price of the share over those days. You end up with a line that looks something like this. This is the 300-day moving average. So for each day plotted on the FTSE 100 price chart, You're also seeing the average price of the FTSE over the previous 300 days. It's what's called a lagging indicator, in that it shows you the price trend, but with a significant lag because it relies on prices from the past. So it's always somewhat behind the action. But you can see how it smooths out most of the chart fluctuations and gives you a more general picture of the ups and downs. Investors often use a moving average like this to decide whether the market is in a bull market or a bear market. For instance, the FTSE 100 started an upward trend in early 2003, which continued until late 2007. The 300-day moving average finally bottoms out in November 2003, and it starts trending upwards. And it tops out in December 2007. So by only buying shares when the moving average is trending upwards, investors can be fairly confident that they're not buying during a bear market. It's a rough and ready tool, but it can help stop investors from making serious mistakes. Most charting apps will allow you to add a moving average to your price chart, and it will also allow you to define the number of days that you'd like it to average over. For long-term investors, 200 and 300 days are pretty popular choices. Some investors try to buy in early to a trend, rather than waiting until it's clearly well established on the chart. That way they hope to buy at a cheaper price. Tends to work like this. A share falls out of favor. Sellers push the price further and further down. Eventually, most of the people who want to sell have finished selling, but not many people are interested in buying yet, so the price bumps along the bottom, sometimes for months or even years. You can tell that not many people are interested because volume goes down. Volume measures the amount of buying and selling going on. These little bars at the bottom of the chart show how lots of selling was going on during the price decline, but once the bottom was reached, it all goes a bit quiet. Most investors lose interest in the stock, and the daily volume bars are small. Typically, the price then moves up and down in what's called a trading range. Every time the price falls to its lowest point, buyers start getting interested, thinking it's bargain buying time. And they buy enough to push the price back up, but every time the price reaches the top of the range, some investors become sellers, keen to take the opportunity to offload their baggage at an elevated price. So to some degree, these range floors and ceilings become self-fulfilling prophecies because short-term traders quickly recognize them as key levels where the price tends to reverse itself. So every time the price reaches the ceiling, it rebounds as sellers sell in anticipation of the price reversing. Likewise, every time the price reaches the floor, buyers buy in anticipation of higher prices to come. So this is why these levels are commonly called support and resistance levels. The price is supported at the bottom of the range by buyers, and the price rise is resisted by sellers at the top of the range. Eventually, something has to give. Either the buyers aren't strong enough to resist the selling pressure and the price bursts downwards through the bottom of the range, or the buyers gain confidence and force the price upwards through the top of the range, causing what's known as a price breakout. This is when many investors make their move. They see the signal that a new upward trend may be beginning, and so they start to buy. The buying action of many investors together often pushes the price up even higher, which gives the breakout buyers an immediate profit and makes other investors want to buy too. The upward trend, once established, will often attract more and more buyers along the way, and the share becomes popular again. So why do investors tend to ignore underpriced shares and instead persistently do most of their buying right at the top of bull markets just before a big crash? The fact is, we humans are rather sheep-like. A wise old relative may have said to you at some point, "What do you mean your friend told you to do that? If your friend told you to jump off a cliff, would you do it? Would you? But here's the harsh reality. Maybe you would. If everyone you knew and trusted was running towards the edge of a cliff and jumping off, I'm sorry, but chances are you would probably join them. You'd assume they had a good reason for doing it. Maybe your friends know there's a net to catch you at the bottom or something. There are plenty of classic psychological experiments whose results point to that conclusion. And likewise, when all your friends are putting their life savings into dodgy new imaginary cloud software firm Memepot PLC, it's incredibly hard to resist doing the same. There's even a name for this condition now. We call it FOMO, fear of missing out. If there's one emotion just as powerful as the fear of losing everything, it's the fear of not getting everything that everyone else is getting. Nobody wants to be the odd one out, the only loser in a world of winners. So this is why the biggest stock market buying always happens right at the top. Like Warren Buffett says, be fearful when others are greedy. But as usual, it's not quite that simple. There's always fear in the news about the markets. It's often said that the market climbs a wall of fear. It's very easy to get shaken out of the market too early by fear, only to see it continue climbing upwards without you, sometimes for years. And that in itself is a big risk for your future prosperity. So once again, it's a balancing act. It makes sense to stay in the market during the minor ups and downs, but if the whole world's suddenly going shares crazy, then beware. So there you go. We've outlined the main methods investors use to make their buying decisions. As long as I've been investing, most of the chat online has been about what to buy and when. People love to discuss these buying dilemmas. What people hardly ever want to talk about, though, is when they should sell. And this is one of the main reasons that so many investors fail to make decent profits. Well, we're going to put that right in the next video and show you how to make that crucial decision.